Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis.
I've been a penny. Buy the stock for a penny.
Start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's Pre-Market Prep. Spencer Israel, as always, here with Joel Elconin and Dennis Dick. Got a busy show for you folks today. They're talking about the Spruce Point from yesterday on XPO in the chat. We're going to talk about that. We're going to talk about just overall just charts that look weak. Not sure where we can find any healthy charts, but we're looking for them. We have earnings from Costco and Adobe. Adobe had a bit of a wild ride after the bell. There's some confusion on what the numbers actually were. So I'm going to bring Brent on in a few minutes, and he's going to help break that down for us. And our guest today, Joe Saluzzi, he would join us at 8:35. He is the partner and co-founder at Themis Trading. Before I throw it to Joel, today's show is sponsored by Wealth Venue, the autopilot investment platform for everyone. Wealth Venue will structure, trade, and rebalance your portfolio so you don't have to worry about making the right investment decision. To learn more, go to wealthvenue.com or click on the link as I put it in the chat right now. And now, Joel, what is the word here in the overnight session?
Oh, man, there's a lot of red on the screen today. We were weak from that 6 p.m. open. Your pre-market high just above the close at 48.75. Your pre-market low is 13.50. I see absolutely nothing there. Your major support is Monday's low at 25.83. You're looking for a target on the downside. Crude in the red by 33 cents. Popped yesterday, giving back all those gains today. Still in a 50 to 54 trading range. Gold in the red by 570 at 1241.70. Silver in the red by 19 cents. And Bitcoin is having a good day. It's flat here. The Bitcoin futures at 32. Triple D, based on that enthusiastic pre-market show, boy, oh boy, we got a lot of things to discuss, and they're all not so rosy. How you doing this morning?
Yeah, we're just looking at a sell-off here again. I mean, same story here. This overall market weakness still persists. I mean, this is why I keep saying don't chase the rallies. You know, we were up here a couple days ago, and people are up there. They're chasing it again. I'm going to keep saying it. It's not the market to chase it. I don't ever like chasing. It's kind of like my own rule. But in this market, they give you another chance. It seems to give you another chance in the next day or two. And the sell the rip is still there. The buy the dip is still working sometimes too. Sell the rip seems to work a little bit better. If you were trading Adobe last night, you could have did both because Adobe dipped, it ripped, it dipped. It was all over the place. Let's go talk Adobe quickly here.
Adobe was confusing. So it was out the report at like 4:05, 4:06-ish. And I want to bring in Brent Slava on right now from our news desk.
Hey.
Brent, you're here, and I'm going to pull up the filing, the actual press release on the screen right now. Brent, can you explain a little bit about, there was a lot of confusion. Just explain the source of this confusion yesterday.
All right. So, Spence, you got the press release up there, right?
Yes, I do.
Cool. I'm pulling it up on my end of things. So the companies in their press releases, you would think they would make it, relatively easy to get the numbers out. And this is where I'm interested to talk about this today, Dennis, Joel, to get your guys' take on it. If you're looking at that press release, you can see that in the first table in the press release, it's literally like within 1, 2, 3, 4, 5 paragraphs, they show a table. And in that table, on the furthest left, they put their target first. They put the guidance that they had given as of September 13th and October 15th. So what seemed to happen is it seems like there was publications, Benzinga, unfortunately being one of them, also algorithm that reacted to those numbers. There was a lot of places that had 187. And again, that was the guidance. The adjusted figure, which also had some confusion related to it, was actually 190. And so analysts...
And that's in the second column.
That's in the second column. And what happened is they had bought Marketo, I believe, in September of last year, and analysts have not yet incorporated that into their models. So the company gave two adjusted earnings per share figures. They gave an adjusted earnings per share figure excluding Marketo, and that was the 190. And they also gave an adjusted figure, which was 183, and that was including Marketo. So I personally, I look at a million press releases each earnings season, and some of them are uniform, and some of them you look at them and you're like, I don't know why the company would present the information this way. Dennis, do you think this is innocent? Do you think that you do this for any reason, like to try to?
Oh, I think it's innocent. I think it's just confusing. And sometimes these reports, Brad, sometimes they're just even hard to decipher through. Like the headline numbers will be there, but then there's adjustments and you got to back out. Is that the GAAP number? Is that the non-GAAP number? You need a CA almost to analyze some of these financial reports there at times. But I mean, the moral of the story, as we see this again and again, is there's so many algorithms that are trading on the headline numbers. And those numbers come out and they miss. And they don't look to the details. They're looking at the headline. The algorithm's reading the headline. And maybe some of their really good algorithms can read the whole thing in a millisecond.
Right.
But I'll tell you, there's a lot of people running algorithms that are just reading the headline. And they miss, and they see a miss, and they just hit the thing down, indiscriminate selling all the way down. And we go down like 230 last night at Adobe. And then a minute later, it rallies all the way back because the devil's in the details, or in this case, the good stuff was in the details. And the numbers aren't as bad as appeared. And then it was all the way up to 258. So you see this 30-point, crazy spike down, spike up. Probably show that on, the pre-market chart. And, it's just, you've got to be very cautious. And as a human being, I don't know how you can even participate in this headline action off the hop. I guess, maybe the human being that's actually reading and understanding this, maybe, they're coming in and saying, no, this is wrong, and they're going to be buying that dip. So maybe there is an opportunity if you're really good at reading these statements. But I mean, on the headline, the algorithms just whipsaw it.
Well, I mean, the after hours low was 232.81, and then within like literally about 2 minutes, we had been at the after hours high, which was 259. So we don't even have to say, how does this kind of, sort of confusion in a company's investor relations impact the market? We can look and see that it definitely impacted the market. So, I mean, Joel, does this kind of stuff, like, did this mess with your levels that we had a 232 low?
I mean, when stuff comes out on numbers like that and releases, levels are mud. I mean, you just have to be able to, use just half and whole numbers or whatever. Because also, number one, it happens so quickly that, your reaction time to look at a chart, forget about that. So if you are playing these numbers, and I don't, Dennis is the one that is more apt to play these kind of moves. If you have a target, let's say you had a target at 238 and you were short and you really wanted 238, then you have to have the discipline just to put the orders out there. And so what if it went to 234 or 232? In the after hours action, if you don't get something like that on the way down, good luck trying to get it on the way up. So now when I look at the levels, the most important thing to me right now is after all that crazy action, you basically been sitting in a 3-point range between 242 and 245. Dennis calls that price discovery. That's where the volume's coming in. So to me, chance to rally above 245, it's pretty wide open. And if you really go into rally mode, you get anywhere near 250, 150. That was a triple top from the last 3 sessions.
Brent, just a question before we let you go. Is this something you've seen in other reports as well? Or is this something, that you're saying the new type of accounting that they're using? Is this something you expect to see in coming reports?
It is something that we've seen. What was really weird about this report was why the company's investor relations or press relations chose to put it in the column that is traditionally, unless you're looking at a European income statement, designated for like the most recent quarter. You know what I mean?
Tell me your process, Brent.
Yeah.
And, obviously you guys are pretty quick. The Benzinga Pro team's pretty quick at, getting these reports and then publishing out the numbers.
Yep.
You do that in seconds sometimes. So how do you quickly just grab it? Are you grabbing the headline stuff too? Or do you guys start to look at these columns? Are you looking for these columns to go grab those numbers from? Just tell me the process of how you go about posting those numbers for the Benzinga Pro subscribers.
Yeah, sure. Real good question, Dennis. So the thing about the income statement is, it's always going to be there. You can always sort of like scroll down to the bottom ish of a press release, and it's going to be relatively the same format for like all companies. However, some companies are sort of friendly, and they will put at the very top of a press release, here's some of the most important numbers. They'll put their EPS figure, whether it's GAAP or the adjusted figure. They'll put their sales right at the top. So companies, they'll oftentimes use the little bullets. If the little bullets are up there, we'll definitely use them. But pretty much for the sales figure, we always want to get like the most accurate sales figure that we can. So we'll always kind of like scroll down to the income statement real quick and get the full sales figure.
So he's basically, they're digging, to answer your question, Dennis, they're digging into the filing, the actual filing, or the actual press release. They're not reading off another headline. They're doing the ones reading in the headline, which is when a guidance in a column traditionally reserved for earnings. And then there's two earnings numbers on top of that. That's
confusing as hell for everybody posting it.
It's confusing.
And everybody reading it.
Exactly.
So, even like the news, like obviously the news team here, gets confused on this, and you've got multiple news teams because obviously Benzinga Pro isn't the only news service out there.
Of course.
Probably being confused on this as well. So you probably have multiple news feeds, different numbers coming out, and then there's just mass confusion, especially if you got algos running off of it.
Exactly. So I guess my question to Joel then, like that 232, like that's not a real print, and 259, that's not a real print because it wasn't real.
Well, it was
real.
It happened.
It was under extraneous circumstances, let's say, right?
Right. Okay.
I mean, and this just goes again to show you, unless you can really understand all these reports, I typically don't dig into the details. I let the dust settle. I usually don't trade the initial whipsaw because you know why? I've tried to do it a lot of times, and you might even be like reading that quickly, and it probably trade down to in the 230s for a minute. You might shake out. You might be like, no, I read something wrong, and panic out. I mean, there's just so much action in that first minute after a release. I typically do not trade it. Although I almost got caught on this because I was going to trade the sympathy plays off. You got Adobe, which obviously a lot of your other cloud stocks might move around. You can see Salesforce.com, Splunk, Autodesk. Those all typically move around with Adobe. And on the initial tank of Adobe, I was like, oh, we got to sell some Splunk. We got to sell, but there was just no liquidity, so there was nothing to hit. If there would have been something to hit, in all likelihood, I probably would have been short a few of those stocks, and then I would have whipsawed Adobe back in my face, and I've been like, now I got to try to get out of those stocks. So I do play the sympathy sometimes, and you got to be careful because when when the whipsaw is happening, it's almost, I think as a trader, especially a newer trader, it's almost better to sit that first minute or two out, let the numbers digest, figure it out. Obviously, you're gonna miss out on some good opportunity. But I feel like the risk is more important for me, and it's so hard to control that risk in the first minute. That's why I usually don't participate.
All right, that was a great discussion there. Do we want to? Well, Joel gave some levels already. Do we want to go to?
Yeah,
So how low did we get Adobe on that number, Joel?
232.54.
And then we whipped right up to like what, 258?
Yeah, higher than that. You went to 259.
259. Yeah, that pesky little high on December 3rd of 260. That's where your numbers come into play. And now you sit here and you're in the middle of that. So one issue we just have is that we have an overall weak tape here. So I'm sure that's weighing on Adobe to a certain extent. We've fallen, 1% since Adobe moved these numbers last night. Probably a little bit of that attributed to Adobe, but a lot of the market sell-off is attributed to some other things, which we'll talk about in a few minutes.
You know what? I don't think of all the technical formations I've seen, I don't think I've ever run across this in Adobe. And these are some outside parameters. Earlier in the month, there are actually 7 trading sessions. You had a triple bottom at the 237.50 area, right? And then the last 3 sessions, you had a triple top at the 251 area, 51 and a half. So boom, and now you're almost smack dab in the middle. So that's where your big buyers are at 237 and a half, and your big sellers at 251.50. And who knows what he can do and chop around in that area. So interesting setup here, but I think I just let the dust settle on after that crazy activity.
Jump over to the other headlines. So we're going to go back to the overall market because we've had a pretty good sell-off here overnight. Lots of things to attribute it to. I mean, you've got China obviously weighing on the markets here. China got hit last night again. We're seeing Alibaba very weak here this morning. But I just want to go headline from Reuters here. It was Trevor Hunnicutt that I think broke this, Reuters. And the headline reads, U.S.-based stock funds posted a $46 billion outflow in the week ended Wednesday, so the week that just ended 2 days ago. This is the largest withdrawal on record, dating back to 1992. So they've never had a weekly withdrawal this large, not even in the financial crisis. So what does that mean? You know, when you see, you know, U.S.-based stock funds posting a $46 billion outflow, it means a lot of your smaller people are nervous about this market and selling it. Now, there's some arguments to be made on both sides of this. You can't just always take stuff as face value. I got Kip Harridge, thanks for reaching out here, just tweeted at me and saying, that's what capitulation looks like. Retail investors are the last to sell. So he's arguing that this might have been a capitulatory event where everybody's saying, get me the hell out. And we just saw it in the funds and maybe not exactly in the stocks. I don't know if I'm of the same opinion on that. I think it's still very difficult to tell if we're at this point where we've seen anything capitulatory. I thought we saw it back, back on November 11th, which we kind of did when Nvidia and a lot of those other stocks really, it opened low and came back that day. But we've come back down and we're getting back down near those lows. So it looks like we're going to retest those lows that we set back on actually it was November 20th. So I don't know. I'm torn. How are you reading into this, Joel? You get this huge, outflow.
Well,
a lot of people selling.
I have a question about that first.
Go ahead.
Was that referring to active funds or passive funds? Because there's a big difference.
I'm just reading the headline, so that is a good question, and I'm not sure about the answer to that.
Okay. Well, I would want to.
I didn't write the headline, so I don't know. It's a scary headline though, and it's all over my Twitter, so it's been retweeted a lot of times.
The public is just sick and tired of this volatility. I mean, it's like up 500, down 400, up 5. Tweets moving the market, news, China tariffs. I mean, at this point, the public overall, if you markets for a long time here with the sell-off for the highs, you're still sitting on some decent money, right? So they're just tired of it. There's no clear, signals coming out of Washington that, that this China thing's ever going to be resolved soon. I don't even know if we have a full administration yet after 2 years. I mean, it's just, there's so much uncertainty here that, the public's saying, you know what, maybe I didn't sell the high, buy the low, but it's like the money's better under your mattress. So, I mean, it's just, this volatility is just, I mean, the whippiness, the gyrations in the market at this point, you pull your money out of the market and at least it's safe. So I think that's the way. I don't look at it as a contrarian move. And I think that we're going to see another, week and a half of big pressure on the market. That's when you have the triple witch expiration. That will be a week. Well, that's actually a week from today. And, that's either, a major continuation of a trend or a turning point. In September, on the September expiration, we made the exact all-time high on that day. So I just think there's a lot of nervousness in the market, and we'll see if we can turn on next week's expiration here. But it's just these ranges and the way the market's trading right now is telling me we're not at the bottom.
And, just to make you a little bit more nervous here, and we're not fully on the bear camp here. I think I've still got a little bit of both camps on, buy the dip, sell the rip type, both hats on. But Todd Gordon on CNBC's Fast Money last night, we know our buddy Todd, he comes on our show lots of times as well. Great guy. He had me nervous. I even tweeted at him, like, you're making me nervous, Todd. I tweeted at him after that, and he's like, oh, I'll shave the beard. He was joking with me, but he was making me nervous because what he was saying on CNBC Fast Money, and he made some good points. He was just talking and saying, a lot of the charts do not look good here at all. And he brought up Amazon, and he said this on CNBC Fast Money. He's like, when you look at this Amazon, and I can see kind of what he's looking at. He's looking at, we basically had a huge run up at the end of 2017 and early 2018. We ran from $900 up, over to $2,000. So Amazon basically doubled in less than a year. He was saying, really, the real support for Amazon is way back there at $900. So he said 900 on Amazon. And I'll tell you, when he said that on Amazon on Fast Money last night, Amazon went from 1656 down to 1650 in a matter of a couple of minutes. So he knocked 6-7 points off the price of Amazon last night just because of his commentary there on CNBC. But, you know, he said 900. I mean, does any of his argument here hold water, or is this just, you know, way too, you know, bearish here, Joel?
I mean, if you look at the I mean, he's just looking at the analysis. I mean, for me, I need.
And he did say, I'm not saying it's going there. He's just saying that, you know, if you're looking at this huge run up, there's no real good support until 900. It's a scary statement.
I mean, you can look at this in a lot of stocks. I mean, what if Apple doesn't hold that 163.30, you know, 163.33 low? I mean, you can say the real next major support in Apple is at 150. I mean, he's just looking at the gap, you know, the area of gaps in the market. And we talk about this a lot. When stocks go up quickly through an area, very quickly, less liquidity, then boom, it's the same. It's even going to be faster on the way down. So the fact that we breached, you know, that 2603, we got a little bit of recovery rally. I mean, it just not, you know, we got earnings season coming up, but even we had a good earnings season, that really, you know, overall, it really didn't help things. They come out with good earnings and bad guidance. But, you know, it's just we need to get rid of this volatility, and I just don't see it going away anytime soon.
No, it's just because there's just too many, you know, nervous people out there. And the only play I keep saying is, and I'll keep, you know, and it's almost the biggest position of my investment financial. I think VIRT has got to be kicking some butt. I know I had, you know, in the last 60 days, I think and when they analyze this, probably my best 2 months in the last 5 years. Why is that? Because we're inefficiency traders, and obviously, you know, you're going to get a lot more inefficiencies when you have this kind of volatility. I've always said my trading profits are directly correlated with the VIX. When the VIX is trading at 10, I'm making money. I'm making 11. When the VIX is at 20, I'm typically making twice as much as I am when the VIX is at 10. VIX goes up to 30 and 40, that's where I'm like having really good days. So I think Virtu is going to be the same thing. I think whenever they report their next quarter, I don't know if you can dig in to find out when they're going to report. I think they're going to I think they probably kicked some butt in the last 2 months. So I like this company. It's been held up well. Obviously, you can see the stock chart comparative to the market. I've kind of called it, it's a kind of a VIX trade. So as VIX stays up, you know, Virtu Financial, I think, does better too. Eventually, the VIX will come back in. But the question is, you know, how much money are they making there? So I like this, you know, this play just because I think they capture a little bit of that volatility, and then obviously a lot of their strategies are probably similar to ours. You know, obviously they're just, you know, exponentially doing them across all markets. So I've got to think Virtue Financial's having a pretty darn good quarter.
It's a little early to know for sure when they report. I have an unconfirmed date of February 7th, but we'll probably know more in another.
Yeah, I would think before then, because February 7th is still 2 months away. So unless they just report it, maybe they did just report it.
Yeah. You mean for the prior? Oh, yeah. That they're out. They were out a month ago.
Yeah. No. I mean, no. I want to know this data because the prior quarter wouldn't have incorporated
exactly.
this. That would have been for the ending September.
Exactly.
Or ending. And so, and the volatility picked up in October and November.
Correct.
So I'm thinking it's this quarter they're going to kick butt in. So that's kind of where I'm curious here. October, November, December. I'm going to say, you know, right now out of the last, you know, this is probably going to be 3 of my best months for trading, not for investing. Obviously, I've been joking that I'm probably losing more portfolio than I'm making trading, but you know, you try to hold in the investments for the long term. But I don't know, like it's difficult, you know. Now let's go put on our investing hats just for a minute because we're talking trading a little bit here. I raised a lot of cash in my investment portfolio, and I can tell you the date. It was back after we had that rally, and I was early on it, but it was back around SPY 280 when we sold off dramatically, and then we had the first spike up, and that was the beginning of November. And I was like, you know what? I'm getting, you know, over half my losses, and not that I had losses because I've been investing a long time, but I'm getting half of the recent losses because my portfolio probably dropped 7 or 8% when we went from 290 to 260, and then it came back all the way to 280. So I lightened up quite a bit then. I'm probably sitting, you know, on maybe some of the highest cash that I've had in my portfolio in a decade. And I want to put that money back to work. I was, you know, kind of, you know, playing a market timer a little bit with it, but I'm nervous. And as an investor, I haven't seen that signal that says, yeah, you know, I bought a little bit of Virtue Financial, but I really haven't put, you know, much of that money to work at all. when is the time, do you think just keep sitting on the sidelines with this? Because I wouldn't want to miss a Santa Claus rally with this. I mean, you are getting stocks on the cheap right now. So part of me says maybe I should nibble here just in case, I'm wrong and we don't just start going down. But I don't know. And I think I'm your typical investor here right now, Spencer. Like I can ask you too. I think I'm a typical investor because it's got to be very hard for somebody, we're in the markets every day and I'm confused about it. Imagine somebody who's just looking at their newspaper once a day or looking at their statements once a week or something. They must be massively confused about whether they should be investing here or not.
Yeah, agreed on that. And I want to clarify that stat you gave earlier. Thank you to
Perfect.
Thank you to Christian Fromhertz, who's been on our show before, for doing the math here on Twitter, or for doing the research. So that $46 billion outflow number, that was in U.S. equity mutual funds. Mutual funds are typically actively managed. The ETF flows in ETFs, generally passively managed, were not nearly as dramatic. The total for the U.S. In U.S. ETFs last week, the total was $1.8 billion of outflows. Not as notable as $46 billion in U.S. mutual funds. So
you're saying there wasn't a capitulatory event here, is what Christian's saying. This is more. We should get Christian on the show. I talked with him a couple times. We've been trying to get Christian back. We've had him on a few times. We should get him back because Christian does some good research. So we're telling me we shouldn't be as scared on this numbers as the headline maybe makes us think.
I'm just saying the $46 billion reflects a more active management, a more active approach than the entire market, because we know that mutual funds are generally actively managed. So it tells us that the active investors, the active managers, they ran for the hills last week, but the passive ones did not. So take that as you will.
And I mean, and this is looking under the hood, just at different segments of the S&P 500, which we like to concentrate on. And they're making some comments here about the financials. And you have a couple of your big, 3 of the top 10 of your stocks in the S&P 500 are finance related. Your Berkshire, your JP Morgan, also your Bank of America here. And, the XLF is, you can't exactly, draw apples to apples here, but the XLF is, trading here at levels that we haven't seen since September and October of 2017, right?
Yeah.
Okay, so on a relative basis, if you want to go and you want to look at the S&P 500 and you want to see where we were trading at back in 2017, it's a hell of a lot lower. I mean, on just a relative basis, a big sector of the market is just performing absolutely horribly. And then, look at your stocks like Apple and some of the other tech stocks are showing weakness too. So for this to turn around, the things under the hood don't look good. Yeah. So how is that? How does that bode well for the overall market?
The financials are not healthy. And, we've been talking on the show. If you've been listening to the show for the last year, we get some things right, we get some things wrong. I mean, we've been bearish the financials for the last year. Every time, I've been talking about the banks. If an investment manager looked at my portfolio or a money manager looked at my portfolio, they would be like, where the hell are your banks? They would be like asking me, I have a few Canadian banks, but they'd be like looking like, you're like so underweight financials, it's ridiculous. And that's because I don't like the relative strength. I don't like the fact of Deutsche Bank. I've talked about this on the show probably a dozen times. I don't like the fact that Deutsche Bank is at $8. I think we're going to have a financial crisis over there in Europe. And what does that mean for our banks over here? It means a hell of a lot of problems. I get this all the time, and you see this on CBC. They're like, these things are all trading under book value. They're all dirt cheap. You know what? Are you forgetting what happened in 2007 and 2008? And I'm not saying that is going to happen, but financials were, that's ground zero. So if you think there's anything, bad happening, with the financial situation in Europe, it's going to roll and it's going to get into the US financials as well. So I've been concerned about the financials for a long time. I feel like that's been the tell here. And you're making a great point here. And I think we're starting to catch not only the financials leading the charge down, which they definitely are. I mean, you look at this Bank of America chart, $29 a week and a half ago. It's $24 here today, basically straight down for each, there's one little green candle in there, but basically straight down for 8 trading sessions in a row. I mean, they're leading the charge down. And until they start to show some health, or Deutsche Bank can start to show some health, which you get a little spike there, when you really look at it, bonds on Deutsche Bank, it's an issue. It's a major issue to be concerned about if you're even a U.S. investor. So, there is some things to worry about. The question is, can other sectors pick up the slack? If we don't get the financials back, can the other sectors pick up the slack? There is some strength. There is a few sectors, but it's more defensive stuff. I mean, Procter & Gamble gets another upgrade from Morgan Stanley here today, making a new all-time high. You've got, Johnson & Johnson showing a lot of relative strength. You've got Merck and Pfizer. More defensive issues, big caps, lower PEs, well, not necessarily Procter & Gamble, but, Merck and Pfizer, lower PEs. So the market is still definitely playing defense, but can these stocks hold the market up? I don't know if they can. So we're going to eventually have to get the banks back for the market to rally, and we're going to have to eventually get some of these tech stocks back for the market to rally.
I agree. We got a lot of things, and we got to look at both sides of the coin here, and that's what we try and do here. We try and look at the bullish prospects and the bearish prospects for the market, and look at everything on the whole. But have we covered many stocks today besides Adobe?
No.
Well, I think we're having a good conversation. I think some days warrants us talking the overall market a little bit more than individual stocks. And Chad, if you just want us to talk individual stocks, we're doing the show for you guys. So let us know if you like the tickers, just going through different tickers, better. But I think some days warrants a more overall market discussion. We know in 4 minutes we're going to get Joe Saluzzi on here too. We're talking market structure a little bit too. I think it's healthy to kind of get a landscape sometimes of what we're looking at overall here. And just giving you my thoughts. I mean, this is all just opinions. None of us know anything. And I'm going to say again, if you've got your next door neighbor, you've got your investment advisor saying they know this is a great buy and this is going to be run for the hills. Nobody knows anything. It's hard to predict this market out more than 7 minutes. And I think that was a stat, 7 months or 7 years. Good luck. We don't know what the next headline's going to be. I mean, if you're a long-term investor, which I am, you somewhat stay the course. But, if you are nervous at times, I like to do a little bit of market timing as well. But if you're just in the markets, you hope over the course of the next 20 years, that markets are going to be higher. So that's why I never go to 100% cash, because I don't want to be, all of a sudden exposed to the risk that the market takes off without me.
That being said, let's do one more stock before Joe. Let's do Costco real fast because they did report after the bell. We said yesterday they were probably going to have to blow it away if they wanted to rally this thing after the report. Well, they didn't really do that. The Q3 or the Q1 EPS, $1.73 versus $1.62. Nice beat, but a miss on the sales. 34.3 versus $34.79 billion, and total comps up 8% on a year-over-year basis. So it beat an EPS beat, a sales miss, and not good enough here.
We got this one right. We were nervous about Costco going into these numbers, and for justly so. I mean, the stock has held up very well, but it just kind of looked at a head and shoulders. Not that the technicals mean anything, but it wasn't, like you said, they were going to have to blow it away because the chart just wasn't pretty going in, and sentiment isn't pretty, and they're reporting on a bad, kind of a bad day, I guess. Now it is anyways. So stock's 218. It's off $10. Now it's taken out. It's going to test. There's a vault. So one good news here, if you're a bull, you got all kinds of support that 217. Takes that out. If it loses the 217, you could be $200. Not today. Not today. But if you lose the 217 for you swing traders, there is room down to 200 on Costco. And you know what? You go into these stores and they're jam packed. So, am I concerned that Costco's got major issues? No. But can this stock, it's still trading with a pretty high multiple? Can it go down to the 190s again? Sure it can. This is 217. Maybe that can, maybe it bounces there today, but it is a very important level for the stock.
Yeah, this is a great illustration on the chart. This is like the stuff that Dennis and I really like to look at and focus on. I don't know about your relative strength and your oscillators and your Bollinger Bands or anything. There's a triple bottom there supported by other lows in that area. That's been an area of great support. But if you draw a line there, you do see some other lows in there, but boom, that is an area which is out. So I would keep an eye on that. And Dennis, I just want to let you know that in the Google chat here, we are just saying everyone just loves the discussion that we've had. One person said, I'll listen to whatever Triple D wants to talk about. I appreciate the insight. I mean,
okay, so all we needed to know was that they were liking the discussion. The next one's gonna be on market structure. We haven't talked market structure in a long time, so let's go get Joe Saluzzi.
All right.
We'll talk a little bit other stuff with Joe here too, because Joe can talk a lot of things too. So let's get Joe. Great.
I'm gonna go grab some breakfast, Dennis. And
lots. You like talking to Joe too.
I know.
No, don't go grab Joe. Joe's one of the best guests.
All right, we'll be right back. And then, as promised, we are back now. Joe Saluzzi, he is a partner and co-founder of Themis Trading, longtime friend of the program, first-time caller. Joe, how's it going?
I'm doing well. How are you guys doing today?
We're doing all right. Not you.
We sound better than you, Joe. You got a little bit of a cold going on?
Yeah, I got something, one of those Northeast colds, which is not very good. They tend to last a long time. So, but I knew we were talking today, so let's go.
Oh, nice. So Joe comes in for us, even though he's under the weather. So that's great. Joe, I want to start on a little bit different topic here with you, but who is the now Spruce Point Capital, and they come out with this article, and I don't know if you're following the story there, but I just want to get your thoughts on Citron and all these people who do this research, and they position themselves ahead of the research, so they they disclose it, so they basically come in, short the stock, come and do some heavy research, and then they issue the report. And then obviously, the stock tanks. And we saw this yesterday with Spruce Point Capital and XPO. And I'm like, this stuff to me, and I know, it's legal, but man, is some of this stuff gray. Because I mean, they're doing research, but when you have a traditional analyst that covers a stock, they typically are not taking a position on it. In most cases, they're not even allowed to trade those stocks that they are covering with research. In these cases, in the case of Citron with Andrew Left, in the case of Spruce Point Capital, they short the stock and then they issue this report that they know is going to tank the stock. And XPO yesterday fell 20% on this report. And then in a lot of cases, I believe that they're coming in and actually buying in and covering some of the short on the weakness that they created. How is this really, if it's legal, it's certainly gray. What are your thoughts here on this, Joe?
I mean, I haven't, seen that one in particular, but I've seen obviously Citron, and there's others out there that are certainly market moving analysts, and you see it come across Twitter or wherever it may be, in the stock will react. I mean, I guess it does. First of all, to their reputation, people follow them. People believe that this is, quality research being put out that will move a stock. Now, sometimes it's a self-fulfilling prophecy, right? Where just like a headline crosses Bloomberg, and the stock's algos will read the headline news, and sometimes they pick up the wrong word. Could be here as well. As soon as they see a headline come across, immediately they start hitting the stock, and then it kind of starts that cycle effect, like you said, and then maybe somebody then comes along as the buyer. Banks in the pay, Wall Street analysts, right? They're doing research. Are their clients seeing the information first, or where's the leakage? These questions have been around Wall Street forever. I think this one is different because it sounds like what you're saying is that they're profiting themselves, but they are doing research. And when it comes to if they are putting out knowledge, or information into the public space that the public didn't know about because someone else didn't find it, well, then I think it's quality information that should be out there. If they happen to be profiting, well, they're going to say, well, that's the payment that we're making for that information. I don't know. It's certainly not up to me to determine it. You know, it's more a regulatory issue, like you're saying. I know what you're saying. It just feels wrong, but
I mean, in some cases where, you know, if they're staying short, okay, so I would say I don't have a problem if they're coming in and they're issuing these research reports and they're staying short for a prolonged period of time, you know, like Ackman. Ackman will come out, you know, and he'll give his research or and he stays with his position for sometimes years. And my problem would be is if they're coming in and like buying into, you know, the weakness that they created. I think that's where the regulator needs to make sure they're not doing that. Because if Spruce Point Capital is coming in, and I'm not saying they were doing this, but if for whatever reason they were buying some stock back yesterday after it fell 20%, I think that's where I would have an issue. So if they're staying short and they're staying short for a prolonged period of time, you know, I don't have a problem with. And I wonder if the regulator shouldn't come in and say, hey, you're going to issue these kind of, you know, research reports, no problem, you know, and no problem to position ahead of it. But you're not allowed to cover for like, you know, 60 days or something after you issue it or something like that.
Well,
so,
I mean, it sounds like you're saying if it's manipulative behavior, there's certainly rules against manipulative behavior. And that's where a regulator would have to take a closer look. And, you know, maybe, you know, I'm sure they are at certain times. Sometimes they need a little hint. So, you know, if somebody feels that there's something wrong, tell the regulator and tell them, hey, take a look at this. But, you know, if it's manipulative activity, just like a spoofer, right, who places 50,000 shares on the offer, but he's trying to buy, well, that's manipulative and that's illegal. Well, if that's the case here, then I think you have a point. But, you know, again, not up for me to determine.
Let's jump over. Do we have a date yet here on the Maker Taker pilot? Do they have something projected out? Are we going to get this in 2019?
I hope so. There's no date yet. It is still at the SEC. I believe the SEC will move quickly on this one. They went through a comment period. There was lots of comments written, so I'm sure they're sifting through them. I think what happens now is that they'll take those into consideration, and they may make a few adjustments to the proposal. I don't think it'll be significant, the adjustments. I think there may be some tweaks around it, but we'll get one soon, and hopefully it'll get up by the end of the year of 19, and I think it's going to make a big difference. You know, like we talked about before, this is game changing in the sense of how orders are being routed. So, you know, the stock exchanges, the three majors, the New York, NYSE, and CBO, have been fighting this thing forever, and they've thrown their lawyers and everything at it. They want this thing dead because they know that it's going to affect their payment for order flow. It's going to affect how they sell data. It's going to affect their entire business model. However, they're losing the battle because the institutional clients, they want this. Brokers like ourselves, who are agency brokers, we want this. So, you know, we think it goes through.
Question, just, and I know obviously I'm a trader as well, and part of me thinks, like, I look at these exchanges and their stocks themselves, not that, you know, we're going to put you on the spot here, but you know, like ICE is trading up here not too far off its all-time highs, and, you know, CME obviously is not directly impacted them because they're not as much on that side of it. But you wonder, like, eventually if the stocks themselves of some of these exchanges, you know, NASDAQ is obviously there too under NDAQ, don't eventually show some weakness for that, you know, coming up.
You know, it's tough to tell because I'm certainly not an analyst on those names, but the revenue model of these exchanges are varied. I mean, they do have revenue from various industry, various pieces. And if you look at any of their investor their reports after their earnings, they'll show pie charts of where the money's coming from. However, you know, data sales and information services is a big piece of the pie, and that piece has been growing and growing over the last 10 years. So anything that would dent that piece is certainly going to hurt them in that respect, but maybe they'll pick it up somewhere else. Who knows? You know, there's obviously people who run these exchanges are very smart. They know how to run a business, and when they see something coming down the line that's going to hurt them, they tend to adjust. I think they're fighting this one really hard because they know it will hurt. You know, and not only it will hurt the volumes, it will hurt the data impact, the revenue from the data sales. So tough to determine. I certainly wouldn't want to. Again, I'm not an analyst on these stocks. I don't know how to trade them on the exchange side, but I just kind of, we look at the structural arguments on them. But there's no, you know, I'm not saying anything new here. If you look at the facts and you look at the pie charts, it's a significant amount of revenue from data-related sales.
Let's take this over to the overall market, and we've seen some substantial volatility since last year we were on a show here, Joe. VIX obviously trading up here now at 21, and you've got this volatility. Now, how much of this do you attribute to, you know, these wild swings to nervousness in the market, or is this more market structural where maybe we don't have the liquidity providers that we did in the past? They backed off too much and we're getting more volatility. What are your thoughts here? Is any of this new volatility attributed to, algorithmic trading and market structure?
It's funny because I hear the guys on TV, although everybody blames the algos now, right?
Yeah.
It's like, we've been talking HFT and algos. How long, Dennis? Years now.
2009 is when you were like, I read your white paper that you and Sal put out, and that's when I got involved with it too, and it was great. I mean, you guys were some of the first people to talk about this stuff, if not the first. So that's why you're always like my hero in market structure, Joe. So that's why I always like on this show. I mean, what are your thoughts? Because we see multiple people going on there saying, blame the algos for all this. Is this the algos fault, or is this just a different situation?
You know what I think is what happens when volatility spikes, and again, this is not new. This happened back in 1987, right? When volatility spikes, liquidity will drain from the system quickly. This happened in the flash crash. However, what happens nowadays with electronic trading, it happens much quicker, and it's nameless and faceless. So in other words, who the market makers are today are all electronic traders, right? And they are the ones supplying the liquidity, bids and offers, when there is no natural liquidity in that name. In other words, no retail or no institutional interest. Who's going to be there? Well, it's going to be a market maker. Now, if all of a sudden volatility spikes, why would that market maker, if he doesn't have obligations and if he really don't know who he is, stand there and get hit with 10,000 shares on the bid? He's not going to do it. It doesn't make sense for his profit motive, because they are essentially proprietary traders. So at that point, they're going to pull their quotes, or not pull them. They're going to spread them wider. So you'll notice larger spreads when volatility spikes, and they will also make those quotes smaller. So the displayed quote may only be 100 shares instead of 500 shares. And when that 100 shares gets hit, it's not going to just replenish itself. It's going to go down to the next level. So and this happens all quick now. This is not taking minutes. This is taking microseconds or milliseconds. So as the volatility tends to spike, the liquidity tends to, thin quickly, and you get these rapid moves. And then, some questions are, will certain market makers or proprietary traders further exacerbate the decline by shorting into that move on the downside, or on the upside by buying into it? And this goes both ways, by the way.
Yeah,
it's not just to the downside. So will they exacerbate it further and make it worse because they see the book thinning? They see the book all of a sudden just collapsing, and they say, you know what? Not only am I'm not going to stand there and take a hit, I'm going to get ahead of it and hit it myself. And if that's the case, not only that's a pretty bad thing. So I think what you need still, and we've argued for this for a long time, also market makers, if they're going to get the benefits of being, they should also get some more obligations. But again, no one's going to take a hit when a speeding train is coming down the line.
I mean, back in the day, and Joel, you can probably attest to this too, obviously coming from the floor, but I mean, even if we look at the old specialist system there, you had not only, that they had affirmative obligations, but they had negative obligations as well. And what that meant was they couldn't actively move the market. They couldn't come in there and hit that bid. So, they were always playing more of a passive role. So they weren't just turning around and, starting to slam the bid. Because they had the book themselves, and they actually didn't release the book. And I don't know if a lot of people realize this to the public. I think it was down until 2005 or 2006. And I can remember when we got that information, and it was like, wow, looking at this NYSE open book changed our whole aspect of trading, because now we can see, where the book thins and where it doesn't. The specialist on the floor obviously held that book close to his belt. So imagine him being able to have that book, and then all of a sudden turn around and, okay, I can see my book's thinning. I'm going to start hitting the book myself. I mean, that stuff, couldn't happen. And it basically does now.
Right. But here's the big difference, a huge difference from prior days. Back in the day, before electronic trading and Reg NMS, the NYSE, for instance, had 80% market share, right? So 80% of the trades were done. That specialists knew everything, right? They knew where all the bodies were buried. Now, the NYSE has 25% market share. The rest of those trades are done either on different exchanges or 40% off exchange, dark pools and other broker-dealer, books that are upstairs. So the bodies are buried everywhere now. So it's much tougher to tell what's coming down the pipe. They can't just say, okay, I know where the stock is going. They don't have as much information, which of course lends to their argument as to why am I going to stand there and take a hit. So that's what happens with fragmentation. That's what happens with a market structure that's been created where speed is the most important thing. That's what happens when you get a market that all they care about is access fees and rebates. You get a market like this that just says, you know what, I'm getting that guy out of the way.
Hey, Joe, I just want to hop in here real quickly. Do you know it was almost a year ago to the day? Do you remember?
I'm going to say.
Yeah.
What was it, 19,000 then?
Oh, it was right. It was right. We did it the second or third week in December. I can't remember the exact date. And if you want to find the exact date, it was right around when the merch launched the futures here. And
oh, yeah.
boy, oh boy, did the big boys bring this thing into line with the futures trade and the margin here. I just want to just get your quick comments on it. It was at the minimum at 15, 16,000 with you and Jim Angel. Thank you. Someone said December 16th, the exact date. Thanks, Neil.
Yeah.
Then we talked about it, and now, here we are holding on to 3,000, kind of the way Jim Angel described it. He thought it would go down, but it would be crazy, just kind of way here. Now, as it's been cut in over half and half again here, this end perspective on Bitcoin here at $3,000.
$3,000. I mean, how do you value the damn thing, right? There's no fundamental or even technical valuation methods, which makes me crazy when I hear some of these folks on TV, prior to this last end of the year giving $25,000 price targets. And, who makes this stuff up? Do you just throw the number on the wall and you see what sticks? I mean, it's absolutely ridiculous. And in fact, it's bordering on I don't want to say fraud, but it's behavior that shouldn't be in the market when who's buying or playing around in Bitcoin and cryptos are mostly retail investors. And, there's no real fundamentals here. Who knows? Maybe the thing will run back up again. I don't know. I don't know if there's any valuation. All that matters is what is the next person willing to pay for, right? And when there's fraud and manipulation in the underlying markets, like we know there is, of course, you can't analyze this thing. It's just I don't know what it is. So if they ever want to get serious, Bitcoin, they should be the ones, whoever needs to get a better regulatory sense. They need to grow up. Okay, they need to get a system in place where there are regulators who can say we are analyzing the trading. This is legitimate trading. These are legitimate buyers and sellers. There's something, there's nothing like a stable coin pumping up the price. I mean, what the hell is that, right? So once they finally get there, and I think there are a few guys in the industry that realize that, and then they can maybe eventually mature, and it might become an asset class, because I don't care what you're trading, tulip bulbs, gold, stocks, Bitcoin. If someone wants to pay for it, well, okay, let's make a market, right? Dennis, you were a market maker. Let's make a market. But the thing here is that it's unregulated, or it's loosely regulated, and there's a bunch of fraudsters all over the place. So until they grow up and become an adult, I don't think anybody should touch the damn thing.
Hey, Joe, I have one more question and we'll let you go. And I don't know if you know the answer to this, but I was just reminded while you were talking to Dennis there. Do you know the status of the SEC vote on whether to solicit feedback from companies on quarterly reporting? Because I recall them voting for that a few weeks ago. Do you know what they decided?
On which one? The proxy reporting?
No, on just quarterly reporting. They were going to.
On the quarterly, whether or not to do quarterly, or I don't actually. Okay. I haven't been on that. I haven't been following that as much.
Right. I was just reminded during that.
I mean, it's an interesting concept as well. Is more information better than less? Well, that's an interesting topic. You guys didn't talk about Robinhood today.
Yeah, let's go. Let's talk quickly. Tell us what do you think? Are you guys going to open an account and get your 3%, Joe?
Yeah. Listen, all I can say is there was a guy about 10 years ago, and he was guaranteeing 14% returns. Remember that guy? I think they locked him up for about the rest of his life because there really wasn't anything going on. I think regulators need to take a serious, close look at what these guys are offering and how they intend to get 3% or more, because as I heard an interview yesterday where they were talking about if they were getting more than 3%, they essentially were going to take the difference for them. Okay, that to me sounds like a hedge fund. So there's a lot more questions here than answers. And I certainly also am concerned about SIPC, the insurance fund, versus FDIC, and whether or not SIPC will actually cover cash in an account that wasn't intended to be invested. It was intended to be sitting there as a bank account. There's a lot of questions here, and we don't have many answers. And I think these guys are very good at marketing, but what we're not hearing is some details. So it wouldn't shock me if some regulators come knocking on their door and start asking them to back up some of those claims.
Yeah, I think that's a reasonable expectation. Growth, and then of course how they're gonna, make money offering 3%. There's a lot of questions that we don't know the answers to. Joe Saluzzi.
A lot of questions.
Joe Saluzzi has been on with us. He's partner and co-founder of Themis Trading. join us, even though he is a bit under the weather. Joe, we always appreciate talking to you. Thanks a lot, and feel better.
I feel much better now, guys.
Oh,
Yeah, we're therapeutic for you. We might have to just find a regular spot for you on the show. Joe, great as always. Market structure, market analyst. Thanks a lot.
Thanks, guys. Have a good day.
We are good. We're good for the soul, guys. All right, S&Ps. Joel, where are we at right now? Anything of note?
We got a little bit of a rebound here, Spencer. We're only trading down.
Coming in.
Yeah. This is like everyone just like heard our bearish rants earlier.
They have five in our face. It's got to be the biggest bull. Yeah, probably be up like 500 Dow points here just because we gave a little bit of a bearish rant here for the last 30 minutes. But
we've got a couple things going on. I'm going to look at level of control here, mid-range on the session, 26.31 and a quarter. We get above that. We hold up. Boom. We go up and test the close of 45 and a half, but still feels a little bit heavy. Did anything in imbalance land influence that?
Just GE, just General Electric.
What's going on? Oh man, I'm so mad.
We got to talk about 936,000 to sell G. So it's gonna go.
Man.
You know what? Now I'm getting Joe's cold. Sorry guys. I don't know. I think the low is in, and I was saying if you get a pullback in the low sevens, I'd be interested. I might take a shot here. 666. I just like the thought of 666 being low because that was low in the S&P. If we can get down the low sevens like 701, I might take a shot. Stop out 665 for real. I'm stopping out. If it's not the low, I'm out. But I might take a shot on this as a swing trade. I'd like it to get as close to that as possible though, because I limit my risk. That's why I wasn't buying 750 yesterday because it's too far away. I don't want to risk 10%. So, but now you've got the pullback coming here. So now we get a shot high, 680, 690, $7. Maybe take a shot if it gets down there and, lean on the 666 low.
Yeah, I was looking at that. I should have been a little braver yesterday. I mean, you would have made you thought it was going to $8 or you had the potential to go to $8.
Yeah, Joel, rewind the tape. What did I say? I did not say $8 yesterday, and I said it multiple times. I don't think it's going $8 here today.
You said you would short it
multiple times that I would like this if it got back into the low sevens. I did not say come in there and start buying at 750. So
no, not at all.
I said all the time, I'm not chasing this, but I said I still think I still think right now we have that potential to go to $8 here again. I think we put the low in at 666. Now I read Inch's stuff, and you can talk this. So Inch put out a report yesterday, and that gets me a little bit more nervous because it doesn't look like Inch is going to follow the JP Morgan analyst. What did Inch say over at Gordon Haskett there yesterday after JP Morgan upgraded stock?
Okay. He said that the sale of ServiceMax, which was perceived as the crown jewel asset with GE's digital lineup, marks perhaps another troubling data point supporting the notion that GE is scrambling to sell everything as quick to mitigate near-term liquidity issues. While GE and analysts can downplay the company's liquidity risk challenge, ongoing business fire sales possibly point to a different story. So, pretty strong comments there.
Doesn't sound like he's changing his mind anytime soon and going to upgrade the stock. So that's one thing working against us. And I did say I would not get bullish GE until Inch got bullish GE. That makes me somewhat scared. But this would just be, trying to get that 666 low. I think I'll take a shot. If it gets down, I don't know if I'm going to take a shot at 701 or 7. I'd love it to get down to like about 690, and then I'm only risking a quarter. And leading on the 666 low. To print 665, I'd be out. But anyways, that's my thought.
I have a question.
Set up trades for you.
Wait, Dennis.
What about tax and selling? People still dumping this thing going into year.
Maybe that gives you a shot here.
Okay.
But you could also talk about the rally that could ensue maybe in January after everybody's dumping.
There you go. I like that idea.
Coming in there too. So sometimes you see some of these stocks, and I believe the tax structure got to be out for 30 days, or at least the way it works in Canada. But something to think about there. In any regard here, we can see the imbalance seller is still there. It's still underwater. There's still a lot of issues at GE. I'm just saying that the 666 level, I think
like it.
Defended now. I kind of do. And I don't know whether it's coincidence or whether it's not, but I think there's a shot there for that to be at least the near term low.
Hey, Dennis, quick question. In which of your CFA exams did you learn about the 666 strategy?
It's from the
I
Spencer
learned about after
Israel.
the financial crisis. And you know what? If this one works, I'll write a paper on it. The 666 strat. When stocks fall, 80-90%, they get down to $6.66. That's where they turn. Now, I'd say, and obviously there's not much to it there, but I just find it what a crazy coincidence. And sometimes things just happen to work out in these weird ways. I think of what a crazy coincidence it would be if G went 666, and that's what the S&P bottom up. So maybe I'm just I like the story of it more than anything, but there's probably not that much to it.
All right, and can we get some quick levels from Joel on XPO on what you would do here? Because we talked about.
Oh my gosh, XPO! Oh boy!
So we talked about this with Joe. Yes, we talked about this a little bit with Joe. Spruce Point Capital. Just give us the details of what exactly Spruce Point, came out and said, and obviously knocked the stock down over 20%.
They came out and issued a strong sell report. They see 40 to 60% intermediate downside risk and up to 100% long-term downside risk. And the company, and there's a whole bunch of research to back up their thesis. XPO came out with a response to Bloomberg. They called those claims misleading and significant inaccuracies. And then this morning, XPO announced a $1 billion buyback.
Oh, really? That's funny. So not only that, we're doing a buyback here just to put it in, show you guys up.
Yep.
7.5%. So it's getting a pop here this morning. I'm hands off on this. It's gonna be a drip.
Yeah.
So another headline could come out. This is not for me. I can't control the risk well enough in something like this. At least not today.
You know what? What's interesting, just for anybody that wants to get down and dirty in this, since 6:30 this morning, it's been a couple hours. We've been in a trading range between 46.5 and 48.5. And someone here, I don't know if they picked up some stock on the cheap yesterday, but they want out at 48.5. So I will use that as 1-star resistance, and then 1-star support is the 46.5 level that you've been consolidating at. After that, I think when you have a plunge down to 41.05 and you get $6-7 above that level, the people that are short are starting to bring in a short term. 44.50 was that would be my next level, and then yesterday's low of 41.05 I think is safe for now. I think you'll see buyers ahead of that level.
All right, on that note, we're going to wrap it up for the day. So thanks to everyone for joining us. Today's show, again, was sponsored by Wealth Venue, the autopilot investment platform for everyone. They will structure, trade, and rebalance your portfolio so you don't have to worry about making the right investment decisions. To learn more, go to wealthvenue.com or click on the link that I'm posting in the chat. Thanks to our guest, Joe Saluzzi. Thanks to all of you who joined us both on YouTube and premarket.benzinga.com. That second chat is going all day, even after the show ends. So hop in there and hang out with some traders. Please remember, all the information from our show is for informational purposes only and not meant to be investing advice. And on that note, that's going to do it for us. So everyone, have a good day, have a good weekend, and we'll see you on Monday.